Singaporeans love to debate this question. What actually pays better for retirement? CPF Life, dividends from REITs, or selling my HDB? And honestly, it's one of the most accurate and most important questions for retirement planning in Singapore, because these three options form the core retirement income strategies for almost every Singaporean. Today I'll break them down in simple math, kopi-money logic, and real risks, so you finally understand what truly pays you more in 2025 and beyond. And trust me, the comparison at the end will surprise you. So yeah, stay till the end, because most people focus on returns but forget the biggest risk in retirement: outliving your money. Before we start, this video is strictly for education and entertainment only. It is not financial advice. Please do your own due diligence and consult a licensed financial advisor for your personal decisions. And if you want more Singapore-focused CPF, REIT, and kopi-money content, like this video so more Singaporeans can see it, and subscribe to Wealth for You. Chapter 1. Why this debate matters in 2025. This headline is extremely accurate because CPF Life, REIT dividends, and HDB monetization are the three real, practical retirement income pillars that almost all Singaporeans rely on. And with CPF changes in 2025, rising CPF Life payouts, higher enhanced retirement sum, and evolving REIT yields, this debate is more relevant than ever. Let's break down the three big options Singaporeans compare. Chapter 2. The income that never runs out. CPF Life may not be exciting. No charts to watch, no dividend surprises, but it offers something no stock, REIT, or property can match. A monthly payout that never runs out, no matter how long you live. It's the government's way of saying, even if you hit 100 or beyond, you won't be left without income. Because CPF Life is a government-backed annuity, once you reach payout age, the money comes in every month, automatically, steadily, and for life. No market crashes, no sponsor issues, no DPU cuts. And 2025 made it even stronger. The enhanced retirement sum rose to $426,000, giving payouts of about $3,100 to $3,300 a month from age 65. Even the 2025 full retirement sum of $213,000 pays around $1,400 to $1,550 monthly, lifelong. People often say CPF gives 4%, but here's the nuance. Your retirement account earns a minimum 4% plus 1% on the first $60,000, and another 1% once you're over 55. But CPF Life payouts come from a pooled system, allowing everyone to receive income for life. The key point remains: risk-free, government-backed returns with one of the highest guaranteed interest floors in the world. It makes sense for Singapore: longer lifespans, rising healthcare needs, and living costs that creep up over time. The Escalating Plan even increases your payout by 2% a year to help with inflation. Of course, this stability has trade-offs. Your capital is locked, payouts start only at 65, and returns won't beat REITs in strong years. So CPF Life may not always pay the most, but it pays the most reliably. And for many Singaporeans, that reliability is the foundation of a truly secure retirement. Chapter 3. The flexible kopi-money stream. If CPF Life is your steady baseline, REIT dividends are the kopi-money top-ups Singaporeans love. Regular, flexible, and completely under your control. REITs pay passive income every quarter or half year, and the attraction is simple. You can buy, sell, adjust, or cash out anytime. No waiting till 65. In 2025, yields look like this. Strong REITs like CICT, MIT, Ascendas, and MLT give you around 5 to 6%. Moderate risk names such as FLCT and Impact offer 6 to 7%, and higher-risk names can go 7 to 9% or even more. Put $300,000 into a diversified REIT portfolio at 5.5%, and you get about $1,375 a month, tax-free for individuals. That can match or beat CPF Life in good years. But REITs come with real risks. Dividends can be cut, prices move with interest rates, and emotional investors often panic at the worst time. Still, REITs offer liquidity, potential capital gains, and assets you can pass on, things CPF Life can't provide. So while REITs won't ever be as reliable as CPF Life, they're the most flexible way to boost your retirement kopi-money. Chapter 4. Unlocking your biggest asset. For many Singaporeans, the HDB flat is their largest financial asset, bigger than their CPF and investment portfolio combined. So unlocking it can transform retirement. There are several ways: rightsizing, renting out rooms, the lease buyback scheme, selling and reinvesting, or even moving to JB. Just note, with lease buyback, proceeds must first top up your CPF retirement account to the prevailing retirement sum before you get any cash, so the lump sum is smaller than most expect. Now, when you right-size, the headline numbers can be misleading. Selling a 4-room flat for $650,000 and buying a 3-room for $350,000 seems like you'll unlock $300,000, but the actual cash is usually lower. That's because you must first refund the CPF you used, plus accrued interest, and then deduct agent fees, legal fees, any outstanding loan, and renovation costs for the new flat. In reality, many Singaporeans end up unlocking $150,000 to $250,000, not the full $300,000. The exact amount depends on your CPF history and property timeline. If you invest the actual net amount, often closer to $150,000 to $250,000 after CPF refunds and fees, the passive income will be lower too. At a 6% yield, that works out to roughly $750 to $1,250 a month in passive, tax-exempt REIT income. Still meaningful kopi-money, just based on real-world numbers, not the idealized $300,000 scenario. That can beat both CPF Life and keeping the HDB idle. But unlocking your flat isn't only financial, it's emotional. You may need to adjust to a smaller space, a new neighborhood, or a different lifestyle. And if JB is in the picture, you add currency risk, safety considerations, and healthcare access. Still, no other asset owned by a typical household has this much cash flow potential. For the right person, HDB monetization is the highest paying option. For others, the trade-offs are simply too big. Chapter 5. CPF Life versus Dividends versus HDB. What really pays more? By now, we've covered all 3 pillars: the steady one, the flexible one, and the big asset one. And eventually, every Singaporean will ask the same question. So, which one actually pays me the most? The honest truth? Each one pays the most, but in different ways. CPF Life, the most reliable payout. If you want a retirement where money comes in, confirm plus chop every month, CPF Life is unmatched. Markets move, interest rates swing, recessions come and go. Your payout still arrives quietly and reliably. It protects you from the one risk no investor can run away from: outliving your savings. For pure certainty and peace of mind, CPF Life pays the most where it really matters: security. REIT dividends, the most flexible payout. For those who value liquidity and control, REITs are the kopi-money engine. You can top up on dips, take profits, rebalance, or cash out anytime. In strong market years, REITs can even pay more than CPF Life, sometimes significantly more. But that upside comes with volatility. REITs rise fast, fall fast, and dividends are never guaranteed. Still, for investors who want flexibility, potential growth, and tax-exempt income, REIT dividends pay the most in freedom. HDB monetization. The highest cash flow potential. Realistically adjusted. Your HDB remains the sleeping giant of your retirement plan. Unlocking it through rightsizing, selling, or reinvesting can create meaningful passive income, but the numbers must be realistic. A typical rightsizing scenario unlocks less than the headline amount once you refund CPF used, accrued interest, fees, and renovation costs. Many households end up with $150,000 to $250,000, not the full $300,000. Invest that at 6%, and you're looking at roughly $750 to $1,250 a month in tax-exempt REIT income. Still powerful kopi-money, but based on real-world cash proceeds. This path can offer the highest income boost, but also the biggest lifestyle adjustments. Smaller spaces, new routines, market timing, or even exploring JB living. It has the highest upside and the highest emotional weight. Definitely not for everyone. So, what's the real verdict? There is no single winner. The winner depends on you, your goals, your comfort level, your lifestyle. CPF Life wins if you want lifelong guaranteed income. REIT dividends win if you want flexibility and higher potential returns. HDB monetization wins if you want the biggest cash flow jump and accept the trade-offs. Most Singaporeans don't choose just one. They blend all three. CPF for stability, REITs for kopi-money, HDB for flexibility, and build a retirement that's steady, practical, and truly Singaporean. Final thoughts. The Singapore Retirement Triangle. When you weigh everything, security, income, flexibility, risk, lifestyle, the smartest retirement plan isn't choosing one pillar, it's combining them. CPF Life gives you the safety net that never stops. REITs boost your kopi-money with liquidity and potential growth. HDB monetization gives you the option to unlock real cash flow when it matters. Together, they create a retirement that works in real life. Steady, adaptable, inflation-resistant, and suitable whether you remain in Singapore or explore life across the causeway. Most importantly, it's a retirement that isn't just paper-rich, but cash flow-rich, the way Singaporeans actually live. If this helped you sharpen your retirement thinking, like this video so more Singaporeans can see it, subscribe to Wealth for You, and tell me in the comments, which pillar do you rely on most? CPF, REITs, or your HDB?